Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're taking a look at what's coming up in the fourth quarter of 24 with a person who is directly plugged into a very large amount of data. He is Marvin Lowe. He's a managing director and senior global market strategist in the multi-asset research team at State Street Global Markets. Marvin joined State Street in 2018 and focuses on the rates, foreign exchange, and credits markets. His prior experiences included research roles in the FX, investment grade and high yield credit and equity markets. He got his BS and MBA from Stern, and he is currently an adjunct professor at Boston College School of Management. Welcome back to the podcast.
Always wonderful to be here, Rob. Thank you.
So let's start off with the obvious question. What are you all seeing going to happen in the fourth quarter?
So, I mean, the market definitely is in a bit of a tug of war. It's interesting to see, and a lot of times when we're on the trading desk, we get a little bit too caught up in single basis points move and the minutia of what's driving maybe one asset class one day versus another. But the moves since the Fed started cutting rates really, to me, really shows to me how unsure the market is in terms of how the economy is going to evolve. So remember that when the Fed met, the market thought, or investors thought, if you will, the Fed was going to get funds below 3% by next June. Right now, they don't think we're going to get below 3.30 ever. So, it's a pretty big change. And in a lot of ways, it shows how little confidence there is. It also shows that the market has no idea, and ultimately because the Fed doesn't have any idea. So what we're doing is certainly looking at what our investor flows show. So we have access to a lot of the custodial data. We kind of look at it as a real money data set, kind of the smart money that's in the market, if you will, and they're still taking risk. So I'm encouraged going into the fourth quarter. While we have taken out rate cuts, depending on how you want to interpret those rate cuts coming out of the market, they could be good because that means there's less recession probabilities that are making its way into the market, and real money isn't really overextended on risks to any significant degree. So, we're still pretty constructive, but we're watching tick by tick, if you will, on the rate side of things, trying to understand how it's going to flow into the dollar, which has more global implications, and it seems like stocks always go up.
Right. They do until they don't. So when you talk about risks in the way you analyze those flows, are you talking about volatility, downside risk? What do you mean by risk?
Yeah, we're looking at the type of risk that investors are taking. So again, based on our custodial data, we are able to see whether or not this real money data set is overweight equities versus bonds, whether or not they're holding more cash than they normally do. It gets into minutia of, do they like high yield more than investment grade? And then when we put all of that together, we get a profile of generally they're risk seeking and or they seem more defensive in nature. Going into the cutting cycle, going into September, investor group had been pretty close to neutral for a really extended period of time, because I think there was a question as to whether or not the Fed was cutting rates because it felt everything was going well, or were they cutting rates because they were behind the eight ball? And some of the data that we've seen more recently is that, the economy still seems like it's holding up. Walk into your offices here, it seems like there are a lot of people outside doing what a lot of people do in the Times Square area. The economy is at least in a good space at this point, and those recessionary concerns are moving out of our data set. So it leaves me optimistic that going to the fourth quarter, we can still see risk assets hold up.
Okay. From that time before the Fed met till now, do you have an idea, or is there any way you can characterize as a whole the magnitude of the increase in the risks they're taking?
Yeah. So we've got an indicator. We call it the behavioral risk scorecard. Kind of based on these multi-asset class relationships, it could be as big as a plus 22 or as low as a minus 22, running away from risk as quickly as you can, if you will. It really hardly ever gets beyond 12 to 14. Those are real extremes. Like, for instance, during the GFC, it got to somewhere around a minus 14, maybe minus 16 for a short period of time. Okay. It had been, for the most part, somewhere plus or minus 3 or 4 for the better part of the summer. It's sitting at about +6, +8 now in that range. So, real money has moved a little bit more aggressively into the risk-seeking part of the world. And we're also encouraged from the perspective that overall positioning is not extended either from a risk perspective. You would be concerned if they're very long risk and they're still buying risk, because how much more can they buy? So we're not seeing that type of relationship.
Okay. So still, if you were to, this is an ill fit, but if you were to put a regular distribution over -14 to +14, we're still in the meaty middle.
Yeah, we are. We are. Yes, for sure.
Okay.
For sure.
All right. Well, let me shift a little bit, because I think that, one of the things I find exceptionally interesting right now is that the run-up in tech has created a bit of a conundrum for a lot of investment advisors, many of whom are listening to this podcast. There's been this massive run-up, but it's also, exceptionally interesting to think about what to do. So what are you all thinking about to the tech sector in the U.S. now?
Yeah, so, we kind of look at the world from a global macro perspective. We look at what geographies we like the most, and then we kind of look at where we see the best earnings potential. And we keep coming back to the same thing that we've come back to the last couple of years. U.S. exceptionalism is still, above and beyond anything else that we're seeing in the world. Again, this employment number, it's just one data point, but it does show that the economy is holding up. And then within that, if you want to draw quadrants in terms of where there's the most cash along with the best earnings profile, you get back to this kind of tech discussion. So, I would say you need to be prudent about it for sure. Being incredibly overweight tech probably is not the best idea, but being overweight tech is still probably a fairly decent position to be. We're about to start earnings season right now. Begins tomorrow, actually, as we're recording this. And some of the internals that I look at is that we've had a decent revision downward in expectations over the past quarter. So we're going in from an S&P perspective, thinking overall earnings are going to be up 4%. We started the quarter up 8%. So kind of that 400 basis point decline is, a little bit aggressive relative to history. And most sectors are being adjusted downward. Tech is not. So, again, it gives you a little example of, just where that strength is. Things are expensive for sure. But they've been expensive for a while. And, I really... my roles as equity analyst is like, I want to buy the best companies that I can, and put my capital in that type of management team.
Well, I would, maybe this is a good time to do this. I would like to go back to something you just mentioned. We had a pretty healthy unemployment number this past week. But one of the things that I find confounding is that there are so many different unemployment numbers in the U.S. We don't have a good homogeneous way of counting it over regions. How do you all, where you sit in this like massive fountain of data, how do you all look at that?
I think from an employment perspective, we are, we're hostage to a lot of the official data. It's a big economy. Like you said, there are a lot of different slices to it. And the revisions around those slices have been tremendous over the course of the last year and a half. It's no surprise that the Fed has been caught wrong-footed so many times over the last couple of years, because I think from a response rate perspective, as well as just from changing worker migration patterns, if you will. The foreign worker has really been accretive to this economy over the course of the last year. And it's pretty hard to measure because it captures both legal foreign workers as well as illegals. They try to capture at least that illegal component. I think what we try to do is, I definitely lean probably more on the non-farm. I try not to let one data point frame the entire discussion. I think trends are really important, but you do layer a lot of the other sources that we have access to. The data set that the United States has is incredible relative to the rest of the world. So, all of it is showing to me an economy that is still fairly well supported of the American worker. And when you're thinking about, do you want to add risk going into this fourth quarter, that employment discussion is an important part of it.
Yeah, it is. Obviously the data that the U.S. has is massive compared to other countries, but some of the accuracy of it leaves a little bit to be.
Yeah, no, for sure. It's been a challenge. I don't know if you remember about a month ago or a month and a half ago, everyone got really focused on these revisions that come out quarterly. No one ever looks at them. But all of a sudden, it becomes probably one of the main factors that the Fed used in deciding whether or not they wanted to do 50 or 25 in September, because those revisions were pretty serious. They probably thought that the decline that we saw in overall employment in the summer was indicative of this trend that ended in March, if you will. The revisions only go up until into March of this year, and lo and behold, maybe the revisions weren't that accurate in terms of really framing out the economy. So yeah, it's a challenge, and these revisions continue, I think, to confound all of us in the market.
Yeah, for sure, for sure. Well, I'd like to just turn back to something. So a couple of months ago, you wrote a great paper, and you were on a podcast last. You talked about this, about the midterm risk and the shift in U.S. Treasury ownership.
Yeah.
And who owns it, and et cetera.
Yeah, thank you for mentioning that.
And I want to get you a few more eyeballs on it, because you already put the work into it. But given what we talked about earlier before this, and we talked about this a couple of times too, is that the higher federal debt pile and debt servicing expenses, and this is making this exceptionally interesting. So I'm curious, now that the paper's been out for a few months, what are people asking you about it? What are people saying about it now that it's a little time has passed?
Yeah, you know what? It's been one of the probably best received thought pieces that we put out there. I don't really get much pushback against it, which is really interesting. It is top of mind in terms of what everyone's thinking. A lot of investors are concerned, but they don't know what to do about it, because they've been concerned for decades, and we've still gone through a multi-decade bull market within the fixed income world. I think that maybe some of the more asset allocator type of clients that I talk to, pension funds that are really thinking about the next 20 years, if you will, and what type of cash flow, and they're very much focused on the 60-40 concept and whether or not they should adjust that. That group of investor has the luxury of taking a step back and really thinking about, hey, is a 5.5% 10-year something that is realistic, even if we can get the funds rate to about 3% or so, like the steepness of the curve? Yep. Should we really be looking at different regimes? Is the paradigm, which I think the market has conveniently grabbed hold of, is that once all of this dust settles, and I think the Fed's somewhat in this camp also, that it's going to look like what we experienced in 2015 to 2019, which was incredibly supportive of markets because you had fairly large balance sheets from the monetary side of things. You had, but you had fairly robust employment, but you didn't see any inflation. So it really was a bit of a Goldilocks. And depending on what type of forward instrument you're looking at, 5-year inflation or something like that, there is signs that the market just wants to get back to that type of world. You can kind of understand it. I think if you have the ability to really think longer term, like let's say in 3 to 4 years, what's the shape of the curve? How many treasuries are potentially going to start crowding out other asset classes in the market? Those conversations become really, really interesting when we have them with customers.
Yeah. I guess the other thing that with that Goldilocks economy, it didn't have so many shoes that might drop. There's a commercial real estate shoe that might drop.
Commercial real estate, geopolitics, yep. Weaponization, in my mind, of the deficit itself. There's just so much more that has come to the surface at this time. And interestingly, kind of as a student and sometimes I'm showing my age a little bit because I've gone through really the last few decades, which had fairly aggressive policy responses, whether they were from a regulatory perspective or from a monetary perspective, and kind of understanding why big balance sheets came about, kind of understanding why government-only money market funds exist now, and prime-only is so small because we had the breaking of the buck problem. It's these were all well-intended measures that, depending on who the regulators, depending on who the authorities were, put in place, but I think now we're seeing what some of the unintended consequences are in commercial real estate with regard to kind of how the banking system, if you will, has restructured itself, and kind of the regional bank versus the GSIBs, the super, the top 20 type of banks. They have been forced into kind of this commercial real estate world, and that type of lender is much more beholden to kind of the traditional capital and liquidity flows versus the GSIBs, which have a lot more resources. And I think that if we had a broader distribution of these loans across both smaller regionals or super regionals and the large banks, it wouldn't potentially be as big of a risk. But it is very heavily concentrated in a group of lenders that is probably has less flexibility than the overall banking system. So again, a lot of this is unintended consequences from regulation that has occurred over the course of the last several decades.
Right. Just to paraphrase that a little bit, when you say the mid-level banks were forced into it, you mean because the capital controls on the GSIBs disallowed them from going very far
Yes,
into
exactly,
lending?
exactly. So the amount of capital that they would have had to put, the skeptic in me thinks that a lot of this regulation was put in place to get the GSIBs to buy more treasuries. Because the capital,
Right.
the capital itself
Never
charges
really
against
thought of
treasuries are fairly low.
Yeah.
Lo and behold, after the increasing yields over the last couple of years, all of those treasuries are now held to maturity, so they can't do anything with it. It's again unintended consequences. I do think that this is part of the mosaic in terms of understanding how we got to where we are now, and all those shoes, if you will, that we're trying to really understand.
Yeah. Yeah. I mean, it's fascinating. Well, perhaps we should leave it there because that was quite a bit. I want to give everybody a chance to think about some things. And thank you for being on the podcast again.
Always wonderful. Thank you, Rob.
All right. And thank you all for listening into this podcast. This has been another Compound Insights. And again, I am your host, Rob Rowan.